Hey guys, this is Cassie Purdy with eXp Realty. I'm your Northern Colorado Realtor, and today we have a special guest with us. It is Jessica Foster with NoCO Home Loans. Jessica is one of my preferred local lenders, and we wanted to talk today about rate buydowns. Obviously, it's a high interest rate market right now. Rates are at a 21-year high, right? And so there's some strategy around bringing down your interest rate and bringing down your monthly payments and other numbers. And there's a couple strategies with that. And one of the most popular right now is securing a credit or negotiating a credit from the seller and to use towards a temporary buy down. There's also a permanent buy down, but we wanted to talk about what it means to use a credit to buy down your interest rates and how valuable that can be right now, because as a buyer in this market, it is a really good time actually to be a buyer for every reason except for interest rates. So if we can kind of take care of the interest rate piece of that and keep down your monthly payments, then it's a great time to buy, because you can negotiate on price, you can negotiate for that credit, you can negotiate for closing costs, and you can also negotiate on inspection. So it's actually a really great time to buy. And so without further ado, this is Jessica, and she's just gonna tell us a little bit about your background and your business.
So I am actually in the broker world with my business. I've had NoCO Home Loans open since May of 2019, but have been in the business since 2004, so I've seen a lot of things.
Yeah.
With my company, it's you just get me, so I don't have a lot of overhead, so I'm able to do a lot of unique situations and keep my costs pretty low. Which in this elevated interest rate market, everybody loves saving a little bit of money.
Yes, so she's able to pass that savings on to you and offer a little bit lower interest rates. So that's great. It's been great.
Good. And then to kind of go over the seller funded temporary buy down. That right now is really, really popular. It's wonderful. We've done several of them where we've done even a 3-2-1 buy down. So there's a 3-2-1 buy down, a 2-1 buy down, or a 1-year buy down. Basically what that means is that if you get a 3-2-1 buy down, and today's interest rate is, at 6.5%, then you've got year 1 at 3.5%, year 2 at 4.5%, year 3 is at 5.5%, and then year 3 through 30 is the 6.5%. The reason that these have become so popular is with the way that rates have been, but also another great thing about it is that money that you're getting from the seller when you go to refinance the property, that additional money that's basically sitting in an escrow account for you gets used as a principal reduction at closing, so you don't lose that money. Whereas if you were to get a permanent buy down on the interest rate, which is a lot of questions that we get, why wouldn't we just permanently buy it down? For the same amount of money, well, no, not when it comes to a 3-2-1 buy down, but for that amount to do a permanent buy down, you may only get 0.5% to 1% off the interest rate. So right. You're getting more bang for your buck if you can do the seller funded temporary buy down.
Real life example, because sometimes it's hard when you hear these terms: temporary buy down, 2-1 buy down, permanent buy down. So we'll give you a real life example of how this works. So recently we had a mutual client, when the time that we went under contract, we were able to negotiate a $30,000 seller credit from the seller to the buyer at the time of closing. So that was in the contract. So basically we had $30,000 from the seller to play with. And why it's important to try to go for a credit from the seller versus just getting $30,000 off the purchase price is because by lowering the purchase price, you're actually not moving your monthly payment that much. It doesn't make that much of a difference on if you lower your purchase price versus using the funds to do what we're talking about today, which is to buy down your rate. So going back to the example, we have $30,000 from the seller. In this particular case, they used a combination strategy. So they did a 2-1 buy down, which is a temporary buy down, combined with a permanent buy down. So they took the rate at the time was about 6.5%. That was the market rate when they were locking that in, and so they used about 15,000 of that 30,000 to permanently buy down their rate to what was it, 5.8?
5.875.
Okay, so they permanently bought down their rate to 5.8, which means years 3 through 30, they're locked in at that 5.8%. That's their final rate. And then they also combine that with the 2-1 buy down, meaning that since their final rate was at 5.8, it would be 2% less than that for year one. So 3.8, thank you. 4.8. It's hard to do math. And then even easy subtraction, 2%. Okay, so 3.8% was year one, 4.8% was year two, and then years 3 through 30, they were locked in at that 5.8%. And the beautiful thing about that strategy is in the event that rates don't go down over the next few years as they're predicted to do, they're still comfortable with that final payment and that final interest rate at 5.8%. So it's kind of hedging your bet by doing the combination of the two. In the event that interest rates do go down, then they would be able to refi in those first few years and then hopefully keep the low rate or even lower rate possibly, and change that. The only difference on that would be that whatever funds that they used for the permanent buy down, so that 15K, essentially if they refied in the next few years, that would sort of go to waste, but it's coming from the seller anyways, so it doesn't matter, right?
And it's still better than taking that money off the top from the purchase price.
From the purchase price, yeah.
Because you're only going to get, maybe $100 savings over that. So
right.
Just still
and then as they
money.
do refi in the next few years and they did that temporary buy down, then that 15K, whatever's left over from that, can be applied towards their principal balance. So it doesn't go to waste. So that's cool as well. And we've had people do a full 3-2-1 buy down. So they took the full $30,000 and they applied that towards doing a 3-2-1. So their today's rate -3 was year one, today's rate -2 was year two, and then today's rate -1 was year three, and then years 4 through 30 were today's rates. But the strategy there would really be to refi within those first 3 years, and then you can apply that 30K or whatever's left of that 30K towards your principal balance.
Well, it's actually if you do refinance during that time period where you still have funds from the seller, you are basically getting that off of the purchase price because we're using it as a principal reduction. Right. So it's a win-win situation, and it's the same difference to the seller, right? Whether you're taking it off the price or whether you're getting a credit to apply towards that. But I've got a product right now that is most standard Freddie and Fannie for investment properties. You can't do a 2-1 buy down, which is unfortunate because we have issues, with cash flow currently. So I do have a product that is allowing for self-employed borrowers where we don't actually need tax returns to qualify at all, which is wonderful. But it also has an option to be able to do a 3-2-1 buy down on it too. And they get all the same benefits.
Okay, awesome. Yeah. Making it easy. And then was that for investors?
That is investors.
Okay, so that's for investment properties. So typically the rate buy downs, the temporary rate buy downs, the 3-2-1 or the 2-1, it can only be used on primary residences and with a credit from the seller. But in this case, she has a product that basically, if you're a self-employed investor, then you're actually able, if you can get the credit from the seller, then you're able to do the temporary buy down on an investment property, which is really cool and unique. The rate buy downs, what your monthly payment might be, if you have a particular house that you want to just run some numbers on, definitely talk to us because and if you're in a position, especially where you maybe were locked in at a lower interest rate on your home, but you have a ton of equity. The math might work out if you are having a need to move. The math might actually work out if you apply some of your equity towards the next purchase, as well as employing these strategies of the rate buy downs. And we're seeing that. I'm seeing that. I have clients right now who are doing that as well. So as hard as it is to, have to stomach kind of getting away from those 2 or 3% interest rates, they're really unlocking their equity in their home, and they're being able to do the move when they need to do, which is really what real estate is about. It's about doing what's right for your family when it's right for your family. So, and we're just here to help strategize and do that in the best way, the most feasible way, and also obviously save you money or keep you at a payment that you're comfortable with. So
it's tax-free money, that all the equity that's in your house. And so if you do kind of rearrange everything, maybe you don't put as much down on a property, and we take care of some of the monthly debts, then you don't feel that pain moving to a higher payment, but you actually can fit into your house and fit all your needs that you need.
Yeah.
And again, these interest rates are temporary, I believe, and
that's what we have. But also let's strategize so we can leverage or we can hedge against that as well. So we just want to help you make smart choices for your family if you have a need to move right now. So thank you so much, Jessica, for your time. I could literally go on and on with you. And we didn't cuss once. So so that's it. Thank you guys. Reach out with any questions.